So in this video, I want to go over with you itemized deductions on a 1040 tax return. And the reason I want to go into some detail on this is a lot of tax preparers are asking their clients to provide all this information on their itemized deductions, right? Their charitable contributions, medical expenses, mortgage interest, all this stuff. And a lot of times it's just completely unnecessary because you can't itemize, right? So what's an example of that? So in this example, we've got a single filer, John Q. taxpayer. So if you're a single filer in the U.S., you're going to get a standard deduction, at least for 2019, it was $12,200. And it'll go up a little more for 2020. Everybody gets this, right? So the only way you would want really to itemize, or the only real benefit, would be if you had itemized deductions that totaled more than that amount, right? It's pretty obvious, right? So if we scroll down and we look at a sample Schedule A here, so I filled this out with some model itemized deduction information for John. But at the end of this, you'll see that all of this was a waste. If your tax preparer is charging you, on a per hourly basis to prepare the return, and they're entering all this information, they're asking you to gather this information, and at the end of the day, the total itemized deductions you have don't exceed the standard, then you wasted your time. The tax preparer overcharged you for the return because they didn't have to do this. And so it's a lose for everybody. Well, I guess the tax preparer wins because he gets to charge you more, but it's not good for you as the taxpayer. So before you go into tax season, you need to ask yourself, okay, well, am I going to have itemized deductions that exceed that standard? If not, then just don't bother, right? Don't bother compiling all this, right? So if we go down the list, so John had $1,750 in unreimbursed medical expenses, right? So he had to go to the dentist, doctor. Those were his out-of-pocket costs. That's useless, right? Because you're only allowed to deduct medical costs as an itemized deduction if that amount exceeds 7.5% of your AGI, right? So his AGI is $81,000. That's the 7.5% figure. Obviously, nowhere close. So if John spent an hour going through his receipts looking up medical expenses, a complete waste of time. There's no purpose in putting this down in there. So as a taxpayer, you ask yourself, okay, well, what's my total income going to look like? Am I going to have expenses that exceed 7.5% of my AGI? If not, then just don't even bother. Just let it go. So taxes paid, here we've got state and local real estate taxes. So John's a homeowner, he paid real estate taxes of $800. So we've got the total there. He's got a mortgage, so he paid $2,600 in mortgage interest. Add that in there. Charitable contributions, so he wrote a couple of checks, $600 in total to charities. Got that down there. And then non-cash contributions, right? He donated let's say, I think it's a table and chairs. So if we go down here, yep. So we got the $82.83 in there. He donated table and chairs to use to Goodwill. So there's again, this is just a form that probably doesn't need to be completed, right? If you're just going to take the standard deduction. Let's see. Yeah, interest. Yeah. Oh, sorry, missed this one. Investment interest. Yeah. So John's got a brokerage account with Charles Schwab, and he was trading on margin during the year. So he racked up some interest on that. So we've completed the investment interest deduction worksheet. To determine how much interest was deductible as an itemized deduction. Got that in there. And so, lo and behold, we get to the very bottom, and his total itemized deductions are $8,100. Not going to use it, right? I mean, we're not going to do that under these circumstances because it's not to his benefit. So, at the end of the day, we're just going to take the standard deduction. Now, there are unique circumstances. I mean, if you have married taxpayers and The married taxpayers want to file separately. Each spouse has to do the same thing, right? So if one spouse wants to file separately and take the standard deduction, and the other spouse has to take the standard deduction, you can't do standard for one spouse and then itemize on the other. So you got to be both standard or both have to itemize. But the takeaway here is, check what all of these expenses might amount to. And again, if you don't think it's going to be over the 12K mark, just take the standard deduction and be done with it. Married taxpayers get the 24,000 plus standard deduction. Now, if you have a home office, then gathering some of these expenses might still be useful, right? So if you're a homeowner and you're a small business owner and you've got a home office, you would still want to gather items like the home mortgage interest and the real estate taxes, because those items are reported first on the home office deduction form, and then it's the unused personal portion that would flow to this schedule. So you still get some benefit for your home office, some additional expenses against your business. But again, ultimately, the personal portions would just flow through to here and wouldn't be used anyway. You would still just use a standard deduction. But very, very important. Just for the sake of saving you some money and some time every year, do kind of a workup before you go to your tax preparer and say, hey, look, I've gone through this. I'm not going to be anywhere near a 12,200 mark or anywhere close to that. So just go ahead and give me the standard deduction, and we'll pass on all this stuff, and then I'll be happy. Okay, so that covers it. Thanks for watching and listening, and I appreciate if you could like the video and subscribe to the channel, and I look forward to seeing you again. Thanks.